We are back with another edition of the Sunday Scaries Stock Talk podcast. I'm joined with special guest Joe, also known as Scoreboard Investor on both Twitter and Common Stock. Joe, how you doing?
Doing well. How are you, Brandon? Thanks for having me.
I'm doing great. I'm doing great. Wonderful. What is it? A wonderful Tuesday night. I got a little tacos in me, ready to talk a little shop. So why don't you tell me about yourself? How did you, I guess, get into the content game? And yeah, when did you start investing?
The content stuff kind of started. Was in a job where didn't really feel like I was getting a ton of engagement, or personal fulfillment from work. So I was looking for something outside of work to, kind of, I don't know, get some more interaction and personal fulfillment. And I've been investing for a while and kind of been observing the financial Twitter stuff from my personal account for a while. And, I was like, I can just share what I'm doing, nothing special, nothing fancy, just flat out, share what I'm doing, try to drive some interaction, engagement, help learn, teach myself, hopefully help teach some other people what to do or what not to do, kind of based off what I do. It's more of a sharing and learning type deal that it started as. But I've been investing for, started in 2015. So did some active investing first, and then kind of got scared out of that. Stepped back into Robo Advisor for about 5 years or so, and then in 2020, kind of started doing some active portfolio management again. So about 2 years now, back into doing some active management stuff.
Nice. That's awesome. Well, let's dial it back a little bit. So I see on your Twitter bio that you're a former NCAA athlete. What sport you play? And I don't know if you want to fully go into it, but where'd you go to school?
Yeah, so I played football, just Division 3, so nothing special. But yeah, I went to Case Western in Cleveland, Ohio. Played offensive tackle, and did that. So
Nice. Yeah. So I'm actually an NCAA athlete as well. I ran track and cross country at the University of Memphis.
oh
So
wow,
athletes in the house for sure.
yeah,
Yeah. Yeah.
athletes and athletes.
Yeah, and then you're also an engineer, which is interesting, because I'm an engineer by trade as well. So, we're both kind of, I guess we got the athletic background, so that kind of instilled the work ethic and the discipline and things like that. But we both don't really have traditional, more, I guess, investing finance backgrounds. But we both kind of find ourselves in this investing financial Twitter common stock realm. So how did you, I guess, find yourself here? How did you even find out about investing? Was there somebody like in your past that kind of told you, hey, like this is a good way to grow your wealth? Or, did you just find it on your own?
Yeah, so kind of from a young age, my dad always like kind of stressed not frugality, but paying yourself first, and was always talking about once we got jobs to take advantage of 401k and things like that. So that's really where I got started. And then Case has a pretty strong finance program, so had some friends that were in finance majors that kind of shared in school some investing and budgeting principles and stuff. So kind of was that base understanding that it was out there. And then some friends after we graduated started getting, that's when Robinhood was really, kind of getting launched back in 2015. And so some friends were in Robinhood. And so I kind of started there. And then my wife's family is very big, like generational investing, where they've been investing going back to like her great grandfather, like in the 40s. So that's kind of been handed down. So she had like a small portfolio when we got married. So at that point, we kind of combined everything. And then that's kind of the portfolio that I'm actively managing now. I took everything from my wealth front, lumped it in over there, and then took what she had, and then now we're kind of building that together.
Nice, that's awesome. So it sounds like you got I guess almost some built-in mentorship slightly from your wife's family. So that's awesome. So you mentioned a little bit already about the Robo Advisors. So why don't you get into that and kind of like your experience using one of those, because that's actually kind of similar to how I got my start. I started with Acorns, and that's how I usually recommended friends and family get into investing initially, just because it's easy. You don't have to think about it. And a lot of times, they do like these things called roundups or whatever, where you can just invest very small amounts. So how did you find out about Robo Advisors, and what was your experience like using one?
Yeah, so I don't remember exactly how I used Wealthfront. I don't know if it was a recommendation from a friend from school or if I read it in like Morning Brew or something like that. But you know, I was in doing like stock picking in Robinhood and kind of got scared away from that. So learning about the robo advisors where you could, invest money, fill out the initial survey, and they would kind of do everything for you, was really appealing for me because I knew I wanted to stay invested, but I didn't want, to didn't feel like I had the time to do the deep dives and do all the stock picking and, the whole buy low, sell high, like all the very high level, what people think investing is, from the outside. I was like, this is way too much for me. So I got in, set up a Wealthfront account. Actually wrote a post about this last weekend or 2 weekends ago on Common Stock, um, to show how little I knew about investing at the time. I wanted to set up either a Roth IRA or a taxable brokerage, one or the other. I ended up setting up the other type of account. So I was like, oh crap, now I got to go back in and set the other one up. So I had created two accounts then, but at the time now, kind of thankful for that because I was able to build, kind of both of those simultaneously. But I mean, the robo advisor experience was pretty good. Decent growth. I mean, not anything earth shattering, but helped learn about the markets, what kind of macro events cause things to go up and cause things to go down. Because, the thing with the robo advisors, everything's ETFs. So they're not investing in individual companies. So you have kind of like that broad market exposure in your portfolio through robo advisors. So you can see what the broad macro events kind of affect your portfolio. So it's kind of a good way to build slowly and kind of learn in the background. And then the other thing that was cool is if you have under X amount in your accounts, you don't have any sort of management fees or maintenance fees. And then if you send out your referral link, you can get more managed for free. So especially Wealthfront started like a cash account, like a high yield savings, which was really nice. Could send that link out to some people, just for savings accounts, and then that would count towards your investment portfolio. So I ended up getting out of that with, never having to pay a advisory fee. So that worked out pretty well. I know a lot of people have some concerns about the fees that they take out as far as robo advisors.
Yeah, I think I think a big benefit of the robo advisors is that there is, generally speaking, like minimal fees, especially compared to like an active manager. I think it's pretty interesting that you kind of started there as well. I think more and more people are kind of starting in the robo advisor world, just simply because, like you said, it's a little intimidating if you don't know anything about it. You maybe don't trust yourself, and you want to get invested, but learn in the background before you kind of get started, just diving in your money into individual stocks, or maybe you dove into individual stocks and got burned and decided this is maybe a safer route until you learn a little bit more. So then you went from Wealthfront to holding individual companies, or did you just kind of implement the same portfolio but still go ETF route?
Yeah, so I kind of kept my Wealthfront separate for a while. We had converted my wife's account to a joint account right like at the height of the pandemic. And she had used, was able to use a lot of the money and stuff in there to pay it out off like student loans and stuff. So the only holding left in there was Comerica, which has been talked a lot about common stock. Common stock people are interested in that position, and I have a pretty big story I'm going to be putting out that they asked me to write up on my Comerica position. But so it was kind of trimming that back, adding new capital. My goal at first was to not trim that position at all, just try to add capital to balance it out. But as far as like the template that I got, I don't know if you ever heard of PPC Ian Lopuk. He's a pretty big, I guess, like dividend growth investor. And my father-in-law had sent me something from him. So I read it. He had a really nice spreadsheet, like everything laid out as far as his, companies, his target, equity sectors, things like that. So I kind of used his template as far as like portfolio structure to make sure that I was like diversified, because I felt like I wanted to make sure that I was as defensive as possible, kind of starting this portfolio of individual stocks. So that's kind of how I started, kind of following that template and, picking individual stocks, trying to be diversified. Ended up, I think, getting way too diversified. I was so focused on not having all my eggs in one basket that I think I spread myself out way too thin. So now we're working to reel that back in. But then I ended up, after a year or so, ended up closing my wealth fund accounts and rolling all those assets in to this other account. And then I set up a Roth IRA, self-directed, and rolled that wealth fund in there too. So now it's pretty balanced between individual stocks and ETFs in both accounts. So kind of nice to have that core ETF stuff and then be able to do the, more exploratory individual stock picking on the outside.
Nice. Well, you brought up diversification. Let's get into that a little bit. So you said that you thought that you got too diversified, which is pretty interesting because I think a lot of times now, diversification is kind of a good buzzword. A lot of people let you know that diversification is a good tool to help maintain your wealth but not lose any of it. Where, I think, if you focus a little bit more, you might, if you pick the right company, you have obviously more upside. So why do you think you were too diversified? And I guess what's your viewpoint on diversification now? Do you kind of view it as, as something that you need to have just minimally, or are you still, still trying to focus on diversification on your portfolio going forward?
Yeah, so I think as far as diversification goes, I'm a big proponent of it. I think it has its purpose. I think a lot of the conversations I've had recently, with more technical investors, in common stock, they talk about, once you hit more than like 19 individual holdings, you kind of start diminishing your returns. But I think my problem was, instead of letting positions build, I just added new positions. Every time that I had new capital, instead of adding it to existing positions, I was starting new positions. So within like a year, I had added started probably somewhere 25 to 30 new positions. So, I wasn't really building any positions, and nothing was really growing. So kind of felt that I was spread too thin, having only a share or 5 shares here instead of, taking all that capital and building up, kind of learned my lesson there. So with the self-directed Roth that I started last year, I've been really focused on adding and starting new positions slowly. So a lot less diversified, allowing myself time to build stuff up before I start a new position. I actually started doing something I call my birthday buys. So I only start new positions the week of my birthday every year. Instead of like over the course of the year, just starting new positions whenever I felt like it. It's kind of helping me rein in kind of my over diversification. It's planned, staged out. This time every year I'll add one or two new positions and kind of slowly and steadily increase my diversity, and then allow me to, build positions over the course of the year.
Nice, nice. That's a good strategy. That's an interesting one. I haven't really heard of that one before, but I've heard of people who evaluate the portfolio like once a quarter, or by yearly or yearly. So I guess it definitely makes sense to do it that way. It kind of just keeps you on a schedule. So how do you find these individual companies, and how do you determine, whether or not you're going to, I guess, buy a share? Do you buy shares and then do research, or, switch up that order a little bit?
Yeah, so being an engineer, really big on using spreadsheets and things like that, and wanted to try to take as much emotion out of investing as possible. So I built, like a scorecard tool, I call it, where, I have 5 KPIs that I track, and then based off the aggregate score from those KPIs, and everything's on like a binary scale, you know, 0 or 1. I have some half points in there too, but the highest on my active portfolio, the highest number on that scorecard is where I will deploy capital. And then as far as like my watch list, any company that, hearing conversation that sounds interesting, or, somebody recommends things like that, I have the same kind of scorecard built for my watch list, where I can just have, a huge sheet of a bunch of different companies, just constantly refreshing, updating, where I have all that information, and, can kind of see where my top holdings on my watch list are. And then depending on where I am in my portfolio. So, like, for example, this year in January, for my taxable account, the only sector that I wasn't in that I wanted to be was like railroads. So I picked, my highest railroad stock on my watch list, and that was Norfolk Southern at the time. So that's what I made my birthday buy. And then over the course of the year, as I have capital available, whatever on my active holdings is highest on that list is where I'll continue to deploy. And one of the metrics that I track, I call my conviction score, which is pretty much the overall, all the research and everything that I've done, learned about, is kind of like my score for that. So I give it like a high, medium, low rating. So that's kind of where my research falls in. Everything else is, like valuations and price movements and dividend yields and things like that.
Nice. That's pretty interesting. So it seems like you're almost like momentum investing over time. Is that kind of I guess a good descriptor of your strategy? Like when you see your stocks that you've already purchased go up, you just kind of keep adding to it.
Yeah, it's kind of, I guess momentum would be a good um, description. And then also I look at valuations too. So kind of merging that, momentum plus still having something that's relatively, value based, and then also looking at dividend yields. Pretty much, to break it down, it's like continually iterating on the same portfolio to make incremental small improvements and gains. Kind of, again, an engineering mindset where just continually making small improvements, not trying to do anything to rock the boat and do anything drastic.
I gotcha. Do you use any tools to kind of help you evaluate, or is it all like self-made spreadsheets?
So right now, and up till now, it was self-made, but with common stock giving us that Koifin, opportunity to do the Koifin subscription and playing around with that. And I sat in on they had like a demo the other day. They have that on YouTube, I think. But there's a lot of powerful tools in there. And I'm at the point now where I feel like I've been in this for a few years now. I feel like I can start to branch out a little bit and kind of take off more pieces of the investing puzzle. So I think that'll be a really good resource to kind of look into different metrics and KPIs, kind of look into different things where I can, kind of continually evolve, my strategy.
I gotcha. That makes sense. I mean, as investors and as I guess students who have, mostly self-taught a lot of this or a lot of this, stock and investing stuff. It makes sense to just be a constant learner, constantly updating, and yeah, trying to divulge new information. So, um, on that note, how are you viewing the current times? We're in a very, very inflationary time. Many people describe it as extremely odd and stuff that not many investors have seen before. So you and I were not investing during the 2008 pandemic, but sounds like we're both old enough to kind of, or not pandemic, our recession. I'm sorry, but we were both old enough to experience it or be old enough to kind of be aware of what all was going on. Um, and so, whether your family was hit or not, or friends around you were kind of, aware of it, at least you were aware of the situation. Um, do you think that that has kind of, I guess, shaped the way that you're investing right now? And how are you viewing this very inflationary time? Like, are you changing up any strategies when you see, the CPI prints come out and be like 8.5%?
Not really changing anything as far as investing. Like I said, I've tried to be very defensive. So, bigger sector allocations are in like consumer packaged goods and things like that. So I think my portfolio is already kind of built to handle situations like this. So I haven't really changed anything as far as what my strategy is. Biggest thing right now is just, budgetary wise and having, with the rising inflation, having the money available to continue to put in and invest. That's the biggest effect right now.
Yeah, it's just always needing more money to invest, right? You can never have enough, it seems. Or at least for me, I'm always researching new companies and things like that, and I always want to put in more money, but you got to live every now and then, and it
Mhm.
seems like living is getting a little bit more expensive by the day. Um, so, since you've started investing, have you seen, I guess, any sort of lifestyle change that you've implemented? Do you kind of find yourself being a little bit more frugal than maybe you were in the past? Or any habits, maybe not eating out as much, etc.
Yeah, definitely more frugal. I think I was relatively frugal before, but just very expense conscious. And the other thing, just like I really like thinking about investing in investments, like your personal interactions, with companies. So it's like always having that antenna up, like, okay, Apple, use it every day, you know, going to Target, um, Home Depot, like the daily businesses and brands that I interact with that I know that I'm invested in, I think that's really been a big like change in my mentality is, paying attention to those things, talking with other people, in different fields and different professions, what kind of equipment do you use? Who are your suppliers, who are your customers? Like, what are your relationships like with them? That's kind of really been a cool change in the way that I think about things and interact. Kind of puts a whole different lens and perspective on the world that we live in.
Yeah, it's kind of like the Warren Buffett style, right? So he's always, I don't know how much you've looked into him or if you have at all, but his style is always look around and look at the products you use daily. And those are generally the good companies to invest in because if you find them useful enough, you obviously believe in their products enough to use them daily or on a semi frequently or frequent basis. So probably would be a good company to invest in because you're probably not the only one that's doing that. So yeah, overall just a good strategy to do that. So is that kind of the only way you find companies? You mentioned a railroad company earlier, so I have a feeling you're not using a rail or a train daily, but I could be wrong. So how do you find companies that you're looking to invest in?
So a lot of it, I have kind of, ever since I started getting into it really more seriously the last 2 or 3 years, subscribing to like a lot of newsletters and things, you know, getting involved in, Twitter and things like that. There's always write-ups and articles about companies and, different companies and things like that. Um, so, I use those kind of tools to kind of build watch lists. Um, Having a lot of friends that are in industry, other engineers and things like that, knowing their companies, kind of following them, tracking them. And then also, being an engineer, being involved in industry, knowing companies that we use, services that we use, um, railroad, we, had at the facility that I work at now, we have a railroad that comes through the facility, fill rail cars and material. And so, kind of just looking in that space, what are the major railroad freight companies? This is something that's being used by, industrial places, and then kind of building that list, looking at industry peers. If you look at one company, a lot of sites will show the peers. So then you can kind of take all those and throw them in my watch list and kind of see how they perform.
Gotcha. Well, you don't have to get into specifics necessarily, but what kind of engineering are you in?
Yeah, so I'm a chemical engineer is my degree. Um, Worked in coatings and then worked in plastics. Actually took a new job that'll be starting next week, which will be in consulting. So kind of a career pivot there where I'll be getting exposure to more broad um, based engineering and manufacturing and industry. So that'll be pretty cool.
That's awesome. So, yeah, this is it's interesting. One of the last interview that I had with my buddy John Lidsey, he also just recently went through a job change, and so we kind of went into a little bit of the macro. But I think, at the end of the day, we're all uh, investors in our own right, and we all are, still, have our 9 to 5 jobs and things like that. So, whether you're investing for your day job or investing on the side, I think everybody has a little bit something unique to bring to the table. But anyway, off the little soapbox, what was it like going through like a job transition during a time like this? Because many are calling it the Great Resignation, where a lot of people, especially people probably around our age, are not necessarily staying at one job for a lot longer and trying to move up. They're kind of bouncing around a little bit, maybe even doing some career pivots like you are. Um, so what was it like going through there? And do you think, was the experience like any different than when you got your first original job?
I'll say that the job hunt, job search, the whole process front to back is grueling. Starting to get out there, coming to the realization, okay, I want to start looking, and then getting your resume updated and all that, and just starting to look for opportunities that you would be interested in. It's nice when you have recruiters that contact you, which definitely I feel has picked up recently, and kind of this great resignation era. Um, but kind of looking in your area, things you're interested in, just going through and applications, rejections, applications, rejections. It's not all sunshine and rainbows when it comes to this great resignation where it's just okay, apply to any job and you're just hired. Still a long process. A lot of interviews, talking with a lot of different people. It's an emotional roller coaster, but at the end of the day, if it's something that'll better you and better your career, then it's worth it.
Yeah, for sure. So, have you seen, I guess, even your previous employer, now, have you seen anything different, or have they done anything, I guess, maybe to entice employees more, whether that's, adding days off or paid vacation, or I don't know, increasing 401k match? Has there been anything that you've noticed, change of business wise, uh, there as far as employee relations? And then has there been anything that you've noticed, um, change of business wise, that have been, changed due to inflation, whether it's, supplies, or anything like that? Because I think, we're in a very unique time for businesses right now, where, it's like we said, it's the great resignation. It's hard for them to keep employees, necessarily, and maybe they're increasing benefits and other things to try to entice employees to stay. And then at the same time, it's, getting a little bit harder to run businesses, as supply chains still feeling the hurt from the COVID-19 pandemic. And yeah, and whether you're in engineering or in anything like that, gaining supplies, always changing in price these days, just simply because, the demand, supply chain, and businesses being shut down for extended periods of time, and they're just having trouble catching up. So, have you seen any differences, I guess, in the way businesses have treated employees, as well as, I guess, conducted their business as a whole?
Yeah, so the two places I worked previously have been manufacturing, um, some pretty big manufacturing companies. So kind of change in employee benefits, and you have hourly labor and unionized workforce, and then you have your salary professionals. It's kind of difficult to make those sweeping changes as far as benefits go, and compensation. But definitely, I've seen the changes in supply chain and the supply chain struggles, cost of materials, cost of raw materials, competition for raw materials has been incredible, and trucking shortages. Um, you know, that whole supply chain side, I think, has made a huge impact. But kind of coming out of it now, um, you know, I had worked for another company previously, kind of at the start of the pandemic. Um, so, this is the second time I've gone through this with like the great resignation, whatever you want to call it. Um, but, you know, first company I worked for, it was all still trying to push meet customer demand, regardless of the raw material situation. And it's interesting to see how that has evolved in the course of 2 years, where now customers are understanding of the supply chain situation. They still want their product, they still want their material, but they understand all of the supply chain crunches that are going on right now. So it's kind of interesting to see that transition from, you know, customer didn't really care about supply chain crunches, to now customers being understanding of chain crunches, and knowing that there's probably going to be hiccups in manufacturing and supply, of materials. So that's something that's been pretty interesting, seeing boots on the ground being involved, in the day-to-day manufacturing.
Yeah, I mean, definitely seems, that everybody's becoming increasingly aware of the issues. So, although your customers may understand a little bit, they might not be, I guess, super happy about, the delays in businesses and things like that. Well, let's circle back. Let's get back to investing. Um, so, we've interacted a little bit on common stock and other places. What are, I guess, some of your favorite industries that you're looking into? Do you, I know you kind of mentioned companies that you interact with. Do you have any specific industries? I know you uh, posted a little bit about some pet companies. I believe it was Chewy the other day. But we had Paul Sierra on previously, who kind of went into Petco, and comments were going back and forth on as to which one might be the better company. But are you looking at any specific industries going forward?
Going forward, not necessarily. Just continuing to try to round out my Roth, kind of my sector diversification that I talked about. Um, Really looking at, I think I posted about it last week, but you know, I think financials, that's a sector that I need to get exposure to in that account. Um, Wish I had it. I don't have it up right now. Pull it up here. Healthcare in that account as well, and utilities. Those are the big three that I'm trying to get my plan together for where I'm going to add here coming up next year for my birthday buys in that account. I've had AbbVie that's performed really well for me in my taxable account, and that could be a pretty strong add for my healthcare position in my other account as well. So it's kind of where I'm focusing right now.
I gotcha. So, I guess maybe a little bit harder of a question. How do you determine that one of your positions is a bad position and when to get out of it?
Yeah, that's a good question. So I know that's really big focus for, obviously a lot of investors, and really big on building routine schedule, procedures, just kind of following, the plan and not really straying too much from it. So I set a minimum holding period for myself of 3 years. Um, so, when I start a position, I don't start a huge position, usually only a couple shares. And then depending on how it fits in the rest of my portfolio, it'll rise to the top or fall to the bottom. So my plan is, hold for a minimum of 3 years. And then anything that's less than, a percent of my portfolio, once it hits the 3-year mark, I'll just get rid of it, just drop it off. So then that'll kind of be continuing to add to the winners, better performers, and then naturally let the underperformers kind of fall off. Because if they're not performing well, I'm not going to continue to add to them. So they're not really hurting anything. So that's kind of my stance. Don't want to get too overreactive. Um, Big on journaling and following, my schedule. I have a calendar reminder I set for myself every quarter to, kind of do my overarching portfolio review, see if there's any positions that need trimmed, and, make any changes to my conviction ratings. So try to have, whether that's good or bad, it's just what has worked for me, just try to have it planned out, set out. And, after 3 years, that's when I really make a decision if I'm going to sell or not.
Yeah, I gotcha. Yeah, I mean, on common stock. There's a very cool feature where you can kind of link your portfolio if you'd like. And I think it's interesting here looking at it that, yeah, you have, I know you said you're going to get into a write up, but it seems like outside of Comerica, you only have one company that is, or you don't have any other company that's above 4% in your portfolio. So I see what you're saying about the diversification. So I guess give us a little preview of this write up of Comerica. How did you find this company? And yeah, why do you keep adding to it? Is it, I mean, it seems like it's doing pretty well for you this year. I'm looking at the year to date chart. Year to date, it's up about 3.5%. And in the past year, it's up 28.36%. So give us a little preview of it. What kind of business is it? Like, how did you find it? And yeah, why is it your largest holding?
Yeah, so this goes back to the account, from my wife. That's Comerica is a bank, long term, long time Detroit company. It's where my wife and her family are from. So that's kind of, they had started these investment accounts. Her grandparents have started these investment accounts, and Comerica was like a long time family investment. So they started with a couple shares and then over years and years and years compounded, grew, dividends, reinvesting, things like that, and grew into a really sizable position. And then, like I said, you know, kind of have just been trying to balance that out with adding new capital. I've trimmed that position back a couple times, um, but still have a pretty significant chunk, obviously, from that. And it was, when we first joined this account in 2020, it was beaten down. I mean, I think the stock price was in like the 20s, pretty low back in summer, fall 2020. And then, um, just recently, being Detroit based and then also have a big holding in Texas and California, kind of where the big oil industries are in the United States. They're very heavily tied with the oil industry. So kind of as you see the fluctuations in, your XLE, your VDE, ETFs, you kind of see CMA track the same way. So as oil's had the big run up in the last 6 months or so, so has Comerica. So it's been kind of nice to see holding, and after it was really beaten down, continuing to hold and seeing it continue to go up. But again, it's a long-term family type legacy holding, so a little bit of emotional attachment there. I did not. So I mean, bottom line, I did not pick it. It's just we're just the benefactors of picking many years ago.
There you go. Hey, I mean, it seems like it's done pretty well for you. So, if it ain't broke, don't fix it, just like you're saying.
Yep.
All right, so we'll wrap it up with two final questions. So here's the first one. If you were to tell any of your friends who, they come up to you and they say, "Hey, I want to get started in investing. I just know that you do it." What would be the one piece of advice that you would tell them to kind of get them started?
Yeah. So I actually helped my brother a couple months ago. Kind of posed the same question to me. He had been in Acorns for a while, but wanted to do something more. So I actually got him set up, with a Wealthfront account. So that's kind of where I directed him first. Like we said earlier, I think it's a great tool, a great resource for people that want to get invested, but don't necessarily have the confidence to step in. And the other piece of advice I would say is there's a wealth of knowledge out there. If you're interested, you can go out and find it. I never knew that this whole financial Twitter space was out there. My whole timeline for years and years and years was just sports and, things like that. And I mean, I don't even know how it got on my radar, but I just remember like the first like person I saw tweeting about like stocks and stuff. I was like, wow, people talk about this here. Like, it was just like mind blowing. Um, so, my other piece of advice would be depending on how interested they are, you can get as much or as little information as you want at your fingertips. Just kind of go out and find it.
All right, cool. Well, yeah, I mean that those are both good points. So, just kind of get started and yeah, find all the information you can. And a follow up question to that, and that this will be my last one is, how do you, as somebody that's just getting started, how do you kind of determine whether or not the information you are getting is good? Because I think investing right now has been, very popularized in the news, whether it's investing in the next I guess booming cryptocurrency or a GameStop or something along those lines. So how do you tell people that kind of want to get started by trying to find the next I guess get rich quick scheme?
Yeah. Really good question. Again, really applicable for the environment we're in right now. Um, my advice would be, and I said many times, I'm pretty defensive. So I would recommend if there's something that you're interested in, You don't have to start with 50, 100, 500 share position. You can start with one or two shares, especially with the low fee, no fee brokerages now. Barrier to entry is really low. You know, if you only have $50 to invest, fractional shares, buy a company you're interested in, see what it does for a little bit. As you start to understand it, build that confidence, then maybe throw in a little bit more, add to that position or start a new position. Never leave yourself overexposed is my one piece of advice.
There you go. All right, Joe, thank you so much for your time. Why don't you tell everybody where to find you and where to find your content?
Yeah, so thanks, Brandon, for having me. Really enjoyed this. You can find me on Twitter and Common Stock. Scoreboard Investors, the name of the account, and the handle is at ScoreBD Investor. Couldn't spell out Scoreboard Investor on Twitter, too many characters, so had to shorten it.
There you go. I mean, hey, you got to do what you can. So, all right, Joe, thank you so much for coming on, and thank you for your time. I think the audience is going to, take a lot from somebody who just the average Joe, just getting in there and figuring out ways to grow their wealth and do it on the side of their actual W-2 job. So, I really appreciate it, and I think the audience is really going to enjoy this one.
Yeah, I hope so.
All right, thanks, Joe.
Thank you.